All right, today we are tackling the heavy metal decision. And no, I'm not talking about music. We're talking about the huge, expensive machines that can literally build your business. The big question is, how in the world do you pay for them?
So, let's put you in the driver's seat. Imagine your company just landed a game-changing contract. This is the big one. But of course, there's a catch. You need a brand new $500,000 asphalt paver to get it done. And you need it like yesterday. The clock is ticking. What's your move? This isn't just a hypothetical. For so many businesses, growth and big, expensive gear go hand in hand. We're talking excavators, transport trucks, specialized medical tech. The list goes on. And let's be real, dropping that kind of cash up front just isn't going to happen. And that is exactly where equipment financing steps in. It's the bridge between where your company is and where you want it to be. So right away, you hit a major fork in the road. This is the core decision you have to make right out of the gate. Are you going to lease this new machine or are you going to buy it? Think of it like this. Leasing is a lot like renting. It's all about flexibility and keeping your cash in your pocket. You get lower upfront costs and you can easily upgrade to the newest tech when your term is up. Buying, on the other hand, well, that's about ownership. It's a long-term play. You're building equity, and when all is said and done, that piece of heavy metal is all yours.
So let's dig into the case for buying. When you take out a loan, every single payment you make is building your equity. It's like a mortgage, but for your machine. Once that loan is paid off, you own it 100%. That puts a really valuable asset on your company's balance sheet, which makes you look stronger financially. And a huge plus, you can run that machine into the ground if you need to. No limits on hours or wear and tear.
But then there's the case for leasing, and it is pretty compelling, especially when you think about cash flow. You'll pay way less upfront. Sometimes you don't have to put anything down at all. That frees up your precious capital for other things, like payroll, marketing, or just surviving a slow month. You're basically paying to use the equipment, not to own it. And here's the kicker. When your lease is up, you can just hand back the keys and get the latest, greatest, most efficient model out there. Okay, so you've got your head wrapped around leasing versus buying. Now for the next big question. Where do you actually get the money from? Let's open up the financing playbook and map out your options.
But before we jump into the options, you need to see this number, and you need to let it sink in. 72%. That's how many small business loan applications get turned down by the big traditional banks. It's a tough stat, and it really shows you why just walking into your local branch might not be the easy win you think it is.
So let's break down the major players. First, you've got those traditional banks. Sure, they have the best interest rates, but like we just saw, getting approved is slow and tough. Then you have online lenders. These guys are lightning fast. You can get approved in hours, but you're going to pay for that speed with higher interest rates. Now, in the middle, you have brokers and specialists. For a lot of businesses, this is the sweet spot. They can get you approved quickly, the rates are reasonable, and they get your industry, which means more flexible terms. And finally, don't forget the manufacturers. Companies like Cat or John Deere often have their own financing divisions, and they can roll everything into one neat, competitive package. Now, remember that scary 72% decline rate from the banks? Well, check this out. Specialized financing companies, they have a 91% approval rate. The difference is just massive. So why? It's because these guys live and breathe your industry. They understand the equipment is the real collateral, so they're just structured to say yes way more often. And hey, there's one more tool you should have in your back pocket, and it comes from the government. It's called the Canada Small Business Financing Program, or CSBFP. Now, they don't lend you the money directly. What they do is they go to your lender and say, hey, we'll share the risk on this loan with you. And that makes the bank way more comfortable and way more likely to give you the green light. So always, always ask your lender about it. We've covered the big picture. Now, let's zoom in on the stuff that can really save you a ton of money and a lot of headaches. It's time to talk about the perks and the fine print. Okay, if you decide to buy, your biggest tax perk is something called the Capital Cost Allowance, or CCA. Now, here's the deal. You can't just write off that entire $500,000 paver in year one. Wouldn't that be nice? Instead, the government lets you deduct a chunk of its cost each year as it gets older and loses value. So maybe deduct a big chunk in year one, a little less in year two, and so on. It spreads that tax benefit out over the life of the machine. Leasing, on the other hand, the tax side is usually way simpler. In most cases, your monthly lease payment is treated just like any other operating expense, like your rent or your phone bill. You can typically deduct the full amount you pay in a year, and that lowers your taxable income immediately. It's just much more direct. Yeah, Legal agreements like this can look pretty intimidating, right? A big wall of text. But let's just demystify it. A lease is just a contract between two parties. You've got the lessor, that's the company that owns the equipment, and you've got the lessee, that's you, your business. That's it. This document just lays out all the rules of the road for the time you'll be using their machine.
Okay, we have covered a ton of ground. So how do you actually process all of this and make the right call for your business, your situation? Let's build a simple framework to help you decide. Honestly, it really just boils down to asking yourself three key questions. First, usage. How long are you actually going to need this thing for? If it's for a short-term project, leasing probably makes more sense. If it's a long-term need, buying is probably the way to go. Second, ownership. Is it a big priority for you to actually own this asset when the payments are done? If the answer is yes, well, then you're on the path to buying. And third, the big one, cash flow. How absolutely critical is it for you to keep cash in the bank right now? If every dollar is crucial, leasing is designed to help you protect it. And that really brings us to this final and maybe most important piece of advice from John Elliott over at Jokova Financial. He says, keep your cash in your business for emergencies. Because when you strip it all away, financing isn't just about getting a new machine. It's about building a strong, resilient business that can weather any storm. And cash, well, cash is the fuel that keeps that engine running.